Welcome to Smart Finance 360, the podcast where money matters meet innovative thinking. Every week, we dive deep into the world of finance, exploring trends, debunking myths, and bringing you the latest insights from industry experts. Whether you're a seasoned investor, a financial newbie, or somewhere in between, this is your go-to source for becoming financially savvy. All right, welcome to another episode of Smart Finance 360, Your Mortgage and More. I'm really excited today because I have Lori Johns as a guest here. She is a wonderful loan officer. She's been doing this for 20 plus years, and experience matters. I think this is going to be a really good podcast to go over kind of what, we've seen, and between the two of us is about 30 years of experience, what we've seen in the last, few decades, what are kind of some trends. Really the focus is everything comes in cycles, and so we'll talk about the challenges of what's going on now and how you can go out on top in the future with your decisions now. So Lori, thanks for being on. I really appreciate you.
Oh, thank you so much. Thanks for inviting me. I'm very glad to be here.
Yeah, it's gonna be great. So you've been doing this a while. Tell me a little bit about kind of the ups and downs you've seen when it comes. I think the mortgage world, the word cycle is very cyclical. I think there's a lot of cycles. What have you seen in the last 30 years that you would say that, is different in extremes? There's just a lot of things that happen.
Within the last 30 years, I've seen rates much higher than they are now.
Yeah, higher than they are now. So people are complaining now, but you saw rates, 20 years ago, probably.
7.6 was normal. People would jump at it. So I think it's just really, really a shock for nowadays to see rates as high as they are. But to me, it's normal.
You've seen it. So everything goes in cycles. So obviously what goes up must come down.
Yeah.
The one thing I would say, and you've mentioned this previously, is that during what we call the refinance boom, which we'll have another one, but we were seeing rates in the twos. And I remember getting people these phenomenal payments and everything was great to get them that low, but they didn't understand that those weren't what the rates
really right. They were fake rates.
They were fake rates, kind of just because of what was going on with COVID, what was going on with the market. And what happened there was a huge change in offers. You had to get 15 to 20 offers for houses. And so what happened? Inflation, they're trying to fight it right now.
It went crazy.
Everything went up. So house prices jumped dramatically. And usually, you've seen probably in the last 20 years, you buy a home for like $200,000. It probably jumps to $600,000 after how many years you'd say normally in kind of a normal.
Probably like 7, 8, maybe 10, depending.
But during COVID, we'd see it like within like 2 years.
2 years.
And that's just not healthy. So I thought, okay, the expectations for clients and consumers on what a payment should be on a mortgage is going to be so far-fetched because rates were so low. And at the time, where do you think when rates were in the twos, like high twos, right? Where do you think rates probably should have been at that time?
Okay, I would say 4.755.
I believe the same.
I don't think it should have gone below 4.75.
Yes.
And I think that's hurting all of our people who want to refinance now, not refinance, but want to purchase. They're like, okay, we've had this home for 4 or 5 years. We want to buy a new one. But we're sitting at a 3.8 interest rate. We don't want to jump up to a 6.5 interest rate. But what they don't understand is the amount of equity that they've built in such a short amount of time is unprecedented, right?
Yeah, it's for that quick to acquire that much equity that quick. Yeah, like you got to look at it as not just the rate, but like, oh wow, I have all this equity and I can use this for my gain. So the options, what would you say they could probably do right now with that lower rate?
Well, the options for sure is the buy downs, right?
And so they got multiple buy downs that they can use temporary, and let's dive into the temporary buy downs. So they use their equity to sell their house, but they're really bummed that they have a lower rate. But now they have an opportunity to get what's called, and this wasn't in the market back in the day, so this is a really cool program, but it's called a temporary rate buy down. So what that means is it's temporary. So tell me a little bit about the different types of programs. We'll start with the 3-2-1, then we'll go to the 2-1. There's a lot, but let's start with
There are a lot. I think one of the neatest things is the calculators that we have that can calculate those buy downs.
That's very cool.
So when you're working with your seller as a realtor, basically, you would need to know that number to find out how much of a buy down can we get. Can we get a 3-1 buy down? Can we get a 2 or just a 1? And what that'll do is the seller can help buy your rate down. Actually, the realtor can too, as well. Can help buy that rate down so that your first year, if your rate's a 7% and we did a 2-1 buy down, then your first year is going to be a 5% for that whole year. which gives you a little relief on that payment.
Yeah, definitely.
The second year, you're going to be at a 6. And then our hopes is before we get to the end of that second year, we at least get the rates back down to like, what would you say, 5.5?
I would be thrilled. I would be jumping up and down if rates were 5.5. I'd be the happiest ever, because I'm like, first of all, I think rates should be at that time, if they are 5.5, in the mid 6s. So I'd be like, this is a blessing. Let's go. And then now right now rates are in the 7s roughly. If we go even like mid 6s or even high 5s, that's how many more millions of more borrowers throughout the United States will be approved for that. So I'd be very happy.
Yes, I would too. It's so hard to have your pipeline full of people that are pre-approved, ready to go, but we just cannot find that house that fits their debt ratio.
Yes.
And those buy downs are so valuable. It helps really tip someone's thought from, buying and not buying. I don't want to buy, but if you say, your payment's going to be a little lower for the next couple of years, it's a little softer. I just had a sweet lady that she moved from Colorado to be closer to her family, and we got her a 2-1 buy down, and it's been a blessing for her.
Yes, it's definitely something that can help alleviate the sting of what the previous rate is.
Your previous payment.
Some of the people are, and some of the people are keeping their mortgages because now they have a great rental at a historically low rate. Their cash flow's phenomenal.
Yep.
But the caveat in Utah, the catch that's hard is you're going to have to either stick with that equity in there, or you can maybe get a HELOC, a home equity line of credit, which is probably going to be 9 to 10%.
Exactly.
They don't understand that, and a lot of people don't understand that some of these HELOCs are not 30 years. They're like 5 to 10 to 15. Like, you're gonna have to pay that, or they're variable after 5 years. Like, the home equity line of credit game's a lot different because a lot of times historically they go to a bank and that loan officer really doesn't know much and they're just signing a paper. So be very wary if you're getting a home equity line of credit, but you can tap into your equity without selling your house. That's one of the options. But the temporary 2-1 buy down, I love that you said that. If the rate's at 7%, that's just an example. You can get 5% that first year, 6% that second year, and then refinance hopefully, or you're stuck with 7. If rates are in the 8s, well, you won. You got it at least at 7. That's a cool one. They also have a 3-2-1 buy down where you could literally get your rate, if it was 7, to 4% that first year, then 5, then 6, then back to 7. Again, seller pays.
A little pricey.
The less pricey option is the 1-0 buy down or the 1-1. I like the 1-0 because it's 12 months of 1% lower rate for pretty minimal cost. It's not as much. I mean, it's going to have their calculations, talk to a loan officer.
It's definitely an incentive.
But the 1-1 I love is 24 months of that lower rate. So like, let's say rates are at 7, you can get 6% for 24 months. Really good. And my favorite piece about the temporary buy down is that it's a subsidy. That means if you have any left over in your subsidy, so let's say you're in year 1 of your 2-1 buy down and your rates happen to get better and you refinance, you get that back. So you get that money back, what's called a principal reduction. What that means is, let's say your loan amount's $350 and there's $5,000 left on your subsidy, you're going to get $345,000 on your new loan amount. That's just an example ballpark range, but...
And Kyle, that's all of our goals, right?
Yes.
That is our goal. Our goal is to refinance all of our clients that have the buy downs before their buy downs are up.
That's the goal. We like the buffer of the subsidy, but that's absolutely our goal. And you saying that, because that's our goal, we have a game plan in mind. What's your thoughts right now on the wants versus need markets? I feel like there needs to be, a lot of people are waiting on the sidelines, but the ones who don't sit on the sidelines, what are you seeing with those people?
Well, honestly, buy downs are probably going to go away because the market is heating up.
It is.
And you see a house on the market and you love it and you want to go see it. You might have 4 people putting an offer in. Now, during COVID, we had like 24 people putting an offer in. And we were, doing appraisals and going like $20,000 above appraised value. Absolutely mind-blowing. I don't think we'll get there.
No, but going from like 2 to 4 to 8, it's a big deal. You'll have one of those 8 people that are like, I don't need the 2-1 temporary buy down in my offer.
Exactly.
Seller will accept that.
Yep.
So right now is a great time. I always say this, and people are like, oh, you're a loan officer, Kyle. Of course you're going to say buy. No, I'm like, I just see the trends because we're in real estate. I wish I would have bought my house in 2016 when I definitely could have bought that house in 2016. I bought another house, but I could have bought this one. Just said, you know what, Kyle? Go for the higher budget house. Just go.
Yep.
Because now, historically, seeing how much it is worth now, it's like, everyone says, what's better? It's better to buy now. No, it's better to buy yesterday. It's better to buy last year.
Yep.
Like, urgency is key, but I like this market because it's a want market. If you want something, you really want this house, oh man, you have so much more of an opportunity and the 2-1 buy down to help you be able to get it. Because if you wait anyways, with rates come lower, you're going to have 5x more people.
That's what I'm saying. Yeah. And it's always been that. It's always been don't wait for me, right? Don't wait, because the longer you wait, everything's going to change. And obviously rates have gone up and values have gone up. Get in now, because values are still going to go up. That's not going to stop. And we've been super secure in how we're doing loans that we know there's not going to be a crash. I mean, what's your thoughts on that?
Exactly. I mean, the last crash was obviously in the mortgage crisis, right? Mm-hmm. You could just walk in and they had no doc loans. They called them ninja loans, right? I was like, no, well, I can't remember what ninja stands for, but no income, no whatever.
Just a high credit score. You want a house? Here's your house.
Yeah, exactly. It's like, oh, okay, you could just walk in and get it done.
Yeah.
Here now, it's very stringent. Like you've seen, like people get a loan sometimes. They'll be like, why do you need this document? I'm like, I'm telling you right now, they're making sure that 100% you're going to be able to approved. And so, yes, the mortgage market is very strong. And that's probably why rates are a little higher right now, because the economy, the Fed knows that people can't afford them even though they don't want to. Like, it's kind of a hard pill to swallow to get that $5,000 a month mortgage compared to you'd like a $4,200, right? In Utah. I'm talking about Utah. If you're listening to this podcast and you're in Ohio, $4,200, you can get a mansion, but that would be the equivalent of maybe $2,800 to $2,200, right, in that area.
Yeah.
But in Utah, we're seeing payments in the 4,000s and 5,000s right now.
Okay.
But I think right there is, I think it's people are kind of accepting that that's kind of the payment, and the Fed realizes that they can kind of afford it, but it's because we've done such a good job with the default rates on mortgages. VA loans are performing really well. FHA loans are performing phenomenally well. And the conventional default rate from, 2008 to probably now is very low. Very, very low. And, there's a lot of different things in place that 2008, you could call an appraiser and say, I need it to be this price, and then maybe slip a couple $100. And guess what? That price could come in, right? That's a hypothetical. I don't know if that exactly happened, but now you cannot absolutely do that. You can't even choose your own appraiser.
Right.
You can have a panel of like 20 really good appraisers. Some lenders have that where it's round robin, but it's always random. And I like that. I think it's good for that way, but there's so much more things in place now with underwriting that, I don't think the crash is going to be necessarily the market for mortgages. So that's a good question. What do you think it would be, in general?
When you mentioned how we used to pick our realtors, I had one that rode a Harley Davidson. So when I needed to have a house appraised and it was out of town or farther away, I knew who to call, because that man loved to drive his Harley. So he was he'd like, I'll go. And those were fun, being able to do that. Mm-hmm. But I do like how it is now, because now it's just a lottery. All the appraisers are good.
They're good. And it's just, there's a lot more in place to make sure to protect the consumers. So the consumer's protected, and they are working right now even on title fees, different fees that are maybe excessive in my professional opinion, like the lender policy. It's like, okay, so it's a policy that's going to protect the lender from you defaulting and you have to pay for it. I like that, the the CFPB is looking at that and saying,
right.
I don't know if that sits well. So I think there's going to be some changing on some fees there. Obviously, we have some weird tensions with the NAR lawsuit, which, at the end of the day, I think it's just going to be value proposition at that point.
Oh, yeah,
You're going to have to have that conversation up front, and lenders already have that conversation up front. Like, it's immediately pretty much our first conversation is about compensation.
Change is hard.
Here's this.
Right? Yep, change is hard, but we get used to it. We figure ways not necessarily around it, but ways to work with it, and I think they'll do the same.
What are you seeing right now with consumer debt? Because they have historically low rates for cars and homes. What have you been seeing lately as far as that right now?
I'm seeing a lot of people that I honestly think would still be a great time to do a refinance.
With the blended rate scenario?
Yes. Mm-hmm.
Yeah. So, are you familiar kind of with the blended rate of kind of how to tell that to consumers? But blended would be, okay, my home is 3.25, but my credit card, I have 30,000 in debts, 20%. So your blended rate is going to be roughly at that point like 15%.
Yep.
So you get rid of that credit card debt of 20,000. And I'm using 20 that's very conservative. Some people have 50, 60.
Right.
So you have 70,000 of 20%, and you go to a rate to like 6.5 with paying that off. You're actually going out on top. So that's kind of where I say the blended rate goes.
Gotcha.
People like to spin it like, check our blended rate program. It's like, There's no blended rate program. I'm just doing the math on it, but yeah, it's interesting.
On those though, I do like to counsel my clients because a lot of them like to get those cards paid back up, spend and we have to refinance again.
Go on vacations or stuff like that.
Right. I try to remind them that they're used to paying like a $750 onto their credit card every month. They need to continue that.
Yes.
And pay that onto their mortgage because they really don't want to pay for this credit card for 30 years. But if they're only making a minimum payments, they're going to pay for that credit card more than 30 years if they kept it on the credit card. Does that make sense?
Yeah. Yeah.
So I still think it's a good time to refi when you're in that situation. When you need extra cash flow and just some security to know that you don't have, so much debt going out the door.
I see a lot of people, they have this amazing interest rate on their car or their home. And instead of just saying, oh, this is great. My $2,300 a month mortgage went to $1,800. I'm going to save. They went out and just spent more.
Yes.
So I predict in the next year or two, we're going to see a lot more refinances where people have to go from the high twos to wherever the rates are going to be. Just they're going to be forced because I'm seeing it right now. And I'm just one guy, right? It's a consumer trend, right? When you're seeing this, but I'm seeing a lot of people spend a lot. They're getting a lot over their head. So there's two options. They're either sell their house and get back at it, or they're going to be like simply have to refinance. And a lot of people, what they've done though, they're like, well, we'll just get the HELOC to pay it off. But then they didn't realize that the HELOC rates aren't that great either. They're in the
not that great. And I love HELOCs. So please don't get me wrong when I say
you need to understand it when you do it. Yes.
You have to understand how they work because you can quickly get them maxed out and the rates are higher. So they're very good to help you get out of trouble, but they also can keep you in trouble.
Yeah. If
you're constantly using it. You make a payment, then you pull from it. I think those instances of just a straight refinance, get everything out, put it on that one loan, I still think that's a great way to go for some people.
I think it is, only because I'm getting a lot of calls of people saying, Kyle, I paid $45,000 in interest. I didn't know that my HELOC was only interest only. So if I paid any of this off, you haven't. You've paid none of it off.
None of it off.
And they're like, but I paid $40,000. I'm like, yeah, that was interest only. So they're like, you're telling me I'm going to have to pay additional? I'm like, yes. They didn't understand because they're thinking mortgages. They're thinking principal and interest. Yes, at a mortgage, you're paying a lot more interest up front, but a little's going in principal. But this one where nothing was going down. So he's like, I would have never done this if I would have known that. It was just so easy at the credit union. They looked in my bank account. We signed within like 10 minutes.
And they tell you, oh, you only have to pay $150 a month and you got a, $4,000 or a $40,000 balance. And you're like, that's sweet.
Yes.
And then 3-4 years later, they're like, dang, I still owe $40,000.
Yes. What's going on here? Mm-hmm. And he's getting kind of scared because he's seeing year 3. He's like, after year 5, it's going to be variable. So he's trying to figure it out. He's got a great rate and he's like, what am I going to do here? I don't know what I'm going to do. But that's one of like 15 or 20 scenarios of the exact same scenario that I've seen in the last 3 to 6 months. So, it'll be interesting to see the trends on what will happen with people being have to refinance.
I think we'll see more refinances because you're right. These HELOCs that are 5 and 10 year interest only, after that point, they're going to be principal, interest, and variable. So that 150 is going to go up to like possibly 600 a month.
Yeah. Yeah.
And they're going to be like, whoa.
It's a lot more intricate program. I think people need to know a little more about it. Mm-hmm. And different banks, investors have that. But yeah, I think it's a lot of interesting things going on right now. What do you anticipate, if you had a crystal ball, where you think rates will head in the next 12 months?
Well, it's been a very strange election year.
Yes.
Normally, historically, rates go down, everything goes down, everything gets cheaper right before an election.
Right? Yeah. I usually say that pitch, but I don't know this time around. I'm like,
it's different, right?
Yeah.
We've been saying it for a couple of years now. We're like, wait till the election year. It's going to get better. It always does. And here we are. And we're like, it's not that much better, right?
No.
So let's say 12 months from now, that puts us May of next year. I would love to see 6%, 5.99, 5.875. What are your thoughts on that?
I'm very much hoping the exact same thing, that whoever wins candidate wants to have a good Q1. And Q1, they can show on their books, hey, look, rates are in the high 5s. Like, this is looking good. The economy's, stable. I know the Fed's going to still fight inflation because it's the only thing they're looking at. They got a magnifying glass on that. But I would hope, and again, like we're saying, it's hope just because things are so different now.
Yes.
I would hope it would be in the high 5s. Mm-hmm. And then a lot of people that are on the fence, are wanting to buy, and then a lot of people can refinance, and but I would be jumping up and down.
Anything below 6, because anything in the 5s just sounds better.
Yeah.
Right. Even though 5.99 and 6 is really not much of a difference, but it does sound better.
It does sound better,
softer.
And it feels like that's where rates should be anyway.
I agree.
Because when rates were at 2.75, you were right. I mean, before people were in the high 3s, right, mid 3s. Yep. They probably should have been hovering around the low 2s to high 4, or low 4s to high 4s, maybe even some of the 5.25-ish. So it'll be kind of nice to get maybe where it's back. Where do you think inflation and kind of the appraised values in Utah is going to be heading in the next year or two? Do you see that stopping at all, or do you just see it's going to just keep going up and up and up?
Oh, I think it's always going to go up, but I think it's going to go up at a much slower pace. But I still see it going up. I
agree.
I mean, it is always the time to buy a house is now.
Yeah, I think
you bought it yesterday, fantastic. If you're waiting for tomorrow, you're losing out.
You're always losing. And the key word I like to tell people, especially in Utah, is it's not the rates, it's inventory. We are so low in inventory right now. As long as there's a demand, the supply and demand, that means your house is appraising.
Yep.
So unless we get, and I can't remember what they said, but the shortage in Utah was years. I don't know what the exact years amount, but like when you have that big of a shortage, I already know that house is, you're going to be safe when you buy the house. You're going to appraise well. You're going to have value. You're accruing value. Why? Demand.
Yes.
When you list your house and you're going to have multiple offers, the house will always appraise. Now, like you said, when there's 24 offers, yeah, 50,000 above asking, that's where it gets crazy. And that's where I think the Fed's going to try to control that. But I see, the next cycle, I think, will be equivalent to probably when rates were in the mid to high 5s and we were able to help people refinance the 4s.
It'll be
something like that. From people that are in the high 7s, they can get down to the mid 6s, maybe low 6s. And then, there'll may be some incentives for the high 5s. So that's my prediction. Rates and inventory is the thing.
Yeah, and I think people that are sitting on the fence need to get off the fence. I really do. I think if they're like, I want to buy, but I'm kind of waiting. I'm not sure what they're waiting for.
Don't wait. I'm not trying to do this for because I'm a loan officer and this is my best interest. I'm just saying if
it is in our best interest to help people.
It is, but it's their best interest to get the house they want now because what's better? Getting the house now at a higher rate, you had no offers, you got the house, and then you can refinance later. Or waiting when rates are better, and now you have to compete with 7 or 8 or 10 or whoever. We don't even know.
Which is just starting, right? There were several open houses over the weekend, and the realtors I talked to today said that they've got multiple offers.
Really?
On 3 separate homes. So it's starting, and I want to see all my buyers go and get the best that they can get, right? I want to see them get the buy downs. I want to see them get closing costs. So if you're on the fence, jump off that fence.
Yeah, right now you have a very solid chance to get a temporary rate buy down, to get seller paid closing costs, and only compete with maybe one other offer.
Right.
So I would say it's a want market. The needs market, yes, is always there, but if you want something, the time is now. Well, any last thing any last thing you like to talk about? We got to get you on again because
let's see, Kyle. This has been fantastic.
Yeah, thank you for being
absolutely enjoyed this.
Yeah,
it's been a lot of fun.
I mean, it's fun because you have some experience. We could really dive into whatever, and you could just answer. It's great. So I mean, we'll probably get into more specifics. I'll have you on again about mortgage topics. But this one's good about kind of the current state where we're at. How can some of the listeners listening to this get a hold of you? What's the best way to reach out?
Okay, so the best way for me would just be either text or call me. My number's 801-866-3812. It's 801-866-3812. Or you can find me on social media. I'm all over that.
Perfect. Well, thank you so much. I really appreciate having you on. Anyone listening here, if you guys need a mortgage, she is the best loan officer around.
Oh, thank you, Kyle.